Hi everybody, it's AJ speaking. This is a review of Porsche, the automaker. Up here you can see the ticker of the stock P911. Porsche was IPO'd in September 2022 by its main shareholder, Volkswagen Group. Volkswagen Group still holds a controlling stake in Porsche, so nobody can take Porsche over without Volkswagen Group's consent. The chart in front of you is a candlestick chart, shows the share price development since IPO. You can see that the company was IPO'd around 80 euro per share. So a major rally, which lasted to around summer 2023. Stock was not far off from 125 euro per share. But in the last 2 years, stocks saw only one direction, and it was downwards. And currently, the stock trades at 41 euro per share. This means that the stock is down 50% compared to the IPO, and it's down almost 70% from all-time high. If we zoom in a bit, what happened this year thus far, so this chart shows you the year-to-date trend, and Porsche stock is down 29%. Many who listen to this and look at this chart might say, oh, it all started with Trump entering office, and this is all driven by global tariffs. In this presentation, I want to show you that this is likely not the full story. So let's look at the numbers. So this chart shows you Porsche's latest available financial statement, and I picked the revenue number here on this chart, and you can see that revenue decreased 11% year over year in the second quarter. The total revenue came in just under $10 billion for the second quarter. The first half is down almost 7%. So first reaction might be, oh, this doesn't justify a 70% drop in share price since all-time high. Since, for example, in 2024, revenue was down only 1.1% compared to 2023. So the lack of revenue growth is not explaining this massive drop in share price. But what caused the 11% drop in the second quarter? This chart shows you the primary driver. This chart shows you the average selling price. So at what price did Porsche on average sell a vehicle in the second quarter? And the number is $118,500. For every sizable automaker, that would be a very high selling price, with the exception of Ferrari. But for Porsche, that actually meant a 9% decrease year over year. The average Porsche sold in the second quarter of last year for $131,300. But that still doesn't fully explain the 11% revenue decrease. So that's why we need to look at this chart. This chart shows you total vehicle deliveries, and we can see that deliveries were down 4% year over year. Porsche delivered only 74,900 vehicles. And the first half is down 8.2%. So thus far, Porsche delivered only 146,000 vehicles, and last year, 2024, was down 3% year over year. And last year, Porsche sold a total of 311,000 vehicles, which makes Porsche, in terms of unit sales, a rather small automaker. But what was driving that weakness in sales? So thus far, we learned that the average selling price came down quite a lot, explaining most of the revenue decrease, and also volume came down. Deliveries reduced by 4%, so we can already speculate that likely sales of more expensive vehicles were weak. And this is exactly what this analysis confirms. So this slide shows you vehicle sales by model, and Porsche's most expensive models comprise obviously the iconic 911, but also the Cayenne, Porsche's large SUV. And these two vehicles were in the second quarter exactly the vehicles that saw the largest unit loss. Cayenne's sales decreased almost 18% year over year, and 911 sales decreased 7% year over year. I should point out that in terms of relative decrease, the second biggest loser was the Taycan. It was down 10.9%. But because the Taycan sells at much lower volume, and you can see this here in this chart quite easily, the Taycan is the purple line here, down here. That larger relative drop had much less of a unit effect. That almost 11% drop only reduced units by 503 units, while the 911 decrease of 7.2% had a cost a unit loss of 1,100 units. So now we identified the key weakness in Porsche's top line, revenue line, and that is the Cayenne and 911 product. So many of you might say now, oh, as we speculated, it's all tariffs related. So the answer must be Americans simply bought fewer large Cayenne SUVs and 911s. Well, to see whether that's true, we need to look at a geographic sales split. And that's what you can see on this slide. This is based on Porsche's disclosure, obviously. And Porsche splits its key markets into Germany, North America, and China, Europe ex-Germany, and other markets. And this chart compares the second quarter of 2025 to the quarter that we are discussing with the same quarter of last year. And you can see that all main markets, Germany, North America, China, and Europe ex-Germany, all declined in broadly a similar fashion. The only market that was up was the basket of all other markets. So this would include the rest of Asia, so Asia excluding China. But I think the strongest offset based on other data I've seen most likely came from the Middle East. Porsche obviously sells quite well in oil-rich countries like the UAE or Saudi Arabia. So the big picture is that the decrease in sales is fairly consistent across all large markets. Germany down 11%, North America down 6.5%, Europe ex-Germany down 6.5%, China down 10.4%, other markets strong, up 14.5%. But as we saw, the strong performance in other markets wasn't nearly enough to prevent the decrease in total sales. Total sales came down 4%. And more importantly, it appears that these other markets buy lower ASP vehicles. Otherwise, we cannot explain the significant ASP drop of 9%. So instead of pointing the finger to just tariffs and North America market weakness, the weakness appears to be a lot more widespread geographically. Next, we need to look at what this did to Porsche's gross margin. So gross margin is gross profit divided by revenue. Gross profit is what's left after you paid for the products you sold. But there's one important thing we have to keep in mind when it comes to Porsche's reported numbers. Porsche does include R&D spend in gross profit, meaning the gross profit is lower. It has been reduced by R&D expenses. This is one way of showing it. However, I prefer showing gross margin excluding R&D expenses because analytically that provides a lot more insight when you split production cost, or what is effectively mostly production cost and R&D spend, and don't lump the two together. Luckily, Porsche provides enough disclosure so we can do this in a clean way. In a clean way means we don't have to make any assumptions. So if we do that, if we strip out R&D spend from gross profit, that's the resulting gross margin that is implied. So in the second quarter, this, what I would call standardized gross margin, which is in line with a lot of other automakers. For example, this would be in line with Tesla. Industry-wide, there is no consensus. However, the trend is to showing gross margin in the way I show it to you right now. And the automakers that still use gross margin, including R&D spend, is more a relic from yesteryears, since all newer automakers adopted this type of gross margin reporting. So with that out of the way, let's look at the numbers. So Porsche's second quarter gross margin came in at 23.1%. That is very high, even after this massive drop of 9.2% points. Last year, in the second quarter, Porsche's gross margin was a very strong 32.3%. There is no automaker except Ferrari that comes anywhere close to that gross margin. That demonstrates the effects of Porsche's very high average selling price and its status as a true premium brand. There's a huge difference between, let's call it an aspirational premium brand and a true premium brand. And the difference becomes very apparent when you look at these companies' gross margin. And now when you look closely, you can see that the gross margin dropped by 9.2%. And that is nearly identical with the average selling price decrease. The following, what I'm going to say, is not quite correct, but broadly correct. That number is, or that change in gross margin is indicative that whether you buy a significantly more expensive Cayenne or 911 product or a cheaper model, Porsche's production cost is not very dissimilar. I know some controllers working in an automotive company will get an aneurysm right now, but they too know once you strip out the non-cash charges, it is quite true. So this gross margin of 23.1%, and the fact that it's very high, becomes very clear when we compare it with various other automakers. There's only one automaker at the moment, except Ferrari, that is Hyundai, that is slightly ahead of Porsche. But gross margin should never be looked at in isolation, since it is effectively a completely meaningless metric without context. And that becomes very clear on this slide, because now we look at the absolute number, so what gross profit was actually achieved with this very high gross margin, and the answer is 1.6 billion in the second quarter, and that gross profit is down 48% year over year, and leaves the first 6 months of 2025 down 35% compared to last year. But to truly understand what it means, we need to go one step further, and we need to look at operating profit. And this is what you see on this slide. We can see that operating profit was all but wiped out. Operating profit decreased by 86% to a rather meager 262 million. Keep in mind, Porsche is valued at almost $40 billion. And it's a pure automaker. It has absolutely no AI, no autonomy, no fill in the blank going for it. The by far biggest thing Porsche has going for it is its brand. And that brand in itself is worth a lot of money, but that brand can also be destroyed if the brand's product don't live up to the fans' expectations. And the financial malaise of Jaguar, Aston Martin, and many other brands that were once extremely popular speaks to how quickly fortunes can change. So where does operating profit of 260 million rank Porsche in the second quarter? The answer is basically in the bottom half. It's not loss-making, it's not amongst the Nissans, Neos, Stellantis, Xpeng of this world, but it's near low profitability Chinese company, Geely, BYD, even Ford made almost twice as much money in the second quarter. Poorly performing SAIC, a large Chinese automaker, made almost 3 times as much. Tesla made roughly 3 to 4 times as much, similar to Mercedes-Benz Group. Of course, we need to point out that some of these companies are valued a lot more than Porsche. For example, Toyota, which brought in about 30 times more operating profit than Porsche, is valued about 5 times more. So if we just go back real quick to the 1.6 billion in gross profit, we need to ask ourselves, okay, they only generate 260 million in operating profit. So where did the delta between the two numbers go? For that, we need to look at Porsche's operating expenses. And please note, this does not include R&D expenses. And just on admin, distribution, marketing, selling expenses, Porsche spent 1.3 billion in the second quarter, and that is actually the highest ever second quarter spend, despite, as you have seen earlier, Porsche shrinking for the last 6 quarters. So what's driving this? A big part of it is distribution expenses. Porsche spent over 700 million distribution expenses in the second quarter. However, that number came down by almost 6%. So something else must have pushed it higher. Next, we look at operating expenses. At admin expenses, so which are part of operating expenses, and here also Porsche reduced spending by 5%. So why did operating expenses then increase? And to answer that, we go straight into the model, since I didn't prepare a slide for that item, and that is net other operating result, and Porsche booked a spend of 111 million, and that is in euro. Unfortunately, in Porsche's accounts, there is no mentioning of what is driving the spend, but if I had to guess, I would assume these are various write-offs and potentially also restructuring charges. So if we now go back to operating expenses, you might be thinking, oh, so actually it doesn't look that bad. They brought down distribution expenses, they brought down admin expenses, and this increase of 13% year over year is just driven by what appears to be one-off items, restructuring charges, as AJ said, and potentially some write-offs. So this should normalize. Well, this could be the case, but we have not yet looked at the other big part of the equation, and this is R&D spend, and this is very, very important in Porsche's case. Because please remember, R&D spend is not included in these operating expenses, because these operating expenses have not been normalized. These are the operating expenses Porsche discloses. Because again, Porsche puts R&D expenses into cost of revenue. So this chart shows you the R&D spend Porsche actually booked in the quarter. So booked means it's included in the calculation of profit. This is different from what was actually spent on R&D. And the reason is Porsche applies R&D capitalization, and capitalization is just a fancy word that means I will recognize a spend in the future, but not in the current quarter in which I incurred that spend. And fundamentally, there's nothing wrong with R&D capitalization. This is allowed under IFRS, so the accounting standard that is widely used by European companies and Japanese companies and other companies, but it can be abused, and we'll be looking at this in a moment. So let's just look at Porsche's booked R&D spend. So that is up 32%, and Porsche booked 690 million R&D spend. And that is near record highs. Now we look at what was actually spent in the quarter. The spend is up 5% year over year, and Porsche spent about 640 million in the quarter, and that is significantly below historic peak levels of R&D spending. So in other words, yes, in the quarter R&D spend is up 5%, but you can see on these numbers, Porsche has been cutting back on R&D spend, on actual R&D spend. So the first half of this year is down 24%, and the reason is the first quarter of last year was an all-time high at just under 1.2 billion. But despite this huge first quarter 2024 R&D spend, the total 2024 R&D spend was down 11%. But when we go back to the booked R&D spend, the picture is very different. R&D spend is up 22% in the first 6 months this year, was up last year 19%. So this is like completely different from what was actually spent. So if I go back to the spend, here you can see, so I flip back and forth. So some of you might be confused right now. So how can this be? How can they book more but spend less? And this is where we come to what I typically refer to the sins of the past. So what Porsche did in the past was they capitalized a very large share of their actual R&D spend in a quarter and moved it into future quarters. And now, since Porsche is in kind of a difficult situation, they try to cut back on current R&D spend. But now the sins of the past catch up with them. So now they have to amortize the capitalized R&D spend from past quarters. And amortization just means that the chickens now come home to roost. So they now have to recognize the spend from, in some cases, R&D spend from 5 quarters ago, 8 quarters ago. And this is exactly what is hitting Porsche's income statement now. So despite their efforts to bring down R&D spend, the high accounting charge from that resulted from yesteryears hits them now. And for people who follow my research for a little longer, might remember this is something I was going on last year, that Porsche's extremely high R&D capitalization is not sustainable, and that this would basically haunt them, and this is exactly what is now happening. And to prove my point here, we look at the R&D capitalization ratio, which is the capitalized R&D spend divided by the actual spend. So it can reach a maximum of 100%. At 100%, it would mean all the R&D spend in a quarter was moved into the future. At 0%, it would mean that all the R&D spend in the quarter was was expensed as incurred, which is the standard for example, automakers under US GAAP. For example, Tesla, with I think very tiny exceptions, expenses all R&D spend as incurred. So there is basically none of this capitalization stuff. So now when we look at these numbers, we can see that basically, and remember, in Q3 2022, Porsche IPO'd in September. This means that the third quarter numbers were not yet available. So investors at the time only saw roughly 75% R&D capitalization, and Porsche kept it going for a while, but then went like, I don't know, crazy on capitalization and capitalized almost all of it, peaking at 92.3%. And then they brought it down as the market became a lot more difficult for them, and has now reached a second quarter low of 42.7%. That is still high by automotive standards, but not crazy high anymore as it used to be. And just real quick, some of you might be interested how this capitalization works. So ultimately, what IFRS does, it differentiates between the research phase and the development phase. That's the R and the D in R&D. The principle is that all research must be expensed as incurred, but development spend can be capitalized under certain criteria. And broadly speaking, the way it works is, if something is still quite uncertain, you do really very basic or fundamental research on something, you have to expense it. But once something reaches a stage where commercialization is highly likely, or technical feasibility has been established and proven, then it moves into the area of development, and then it can be considered for capitalization. Since Porsche provides very little disclosure about this, just like all other companies, frankly, we can only speculate based on sort of that basic knowledge how it's applied under the accounting standard. So what we could say from this decreasing capitalization ratio is that there is less R&D spend at the moment that results in something with a very high or near-term likelihood of commercialization. Or Porsche is currently working on things where the economic benefits are not that clear, but there is a whole host of potential other factors that can drive that lower capitalization. It could also simply be that management became more prudent in terms of their economic assumptions, and that drove lower capitalization. If you take a glass half full approach, what could also drive it, that management is trying to create a honeypot. So they recognize a lot right now, which reduces capitalization, and therefore Porsche faces lower amortization in the future. But given the massive drop in basically to almost nothing, I don't think Porsche is right now in a position to strategize at that level. So the honeypot strategy appears to be quite unlikely at the moment, to me at least. So next, let's look at operating expenses on a relative basis. So this shows operating expenses as a percent of revenue. And again, this does not include R&D spend. And even without R&D spend, Porsche spent 13.5% of revenue on admin expenses and distribution expenses, selling expenses, marketing, etc. So that's it's a very large number. And the obvious driver is that of course, Porsche engages in a lot of it's called fancy marketing, because the premium brand sponsors a lot of events, but also it shows Porsche's lack of scale. Porsche sells only slightly over 300,000 vehicles. Yes, they have a very large ASP, but overall Porsche is not that large a company. You can see it here on the revenue. So total annual revenue was last year only $43 billion. But Porsche spent just over $5 billion just on admin and selling expenses. But we have to go a step further, and this is what this chart shows you. This chart standardizes again operating expenses. So what I've done here is I've pulled R&D expenses into operating expenses, because this is more in line with the global standard, or let's call it the more modern global standard. This is also, for example, how Tesla reports it, or basically all the new automakers, and also some of the older automakers, because that way of showing operating expenses just makes a lot more sense, since R&D is not tied to production, and that's why production cost should be separate. So when we then look at these numbers, these standardized numbers, these comparable numbers, Porsche's OPEX margin is outrageously high, at now record high, which is really bad, at just over 20%, 20.4% in the second quarter. And that's why I wrote here in the punchline, Porsche has a cost problem. If you, for example, go back to IPO, so again, September 2022 was IPO, but this number was not available at this time, and I doubt, I have to go back and check, second quarter number was highly unlikely, was highly likely not available either. So investors probably only had first quarter numbers, and they looked at the time of a total operating expenses as percent of revenue of just 13.3%. And now Porsche is at 20.4%. So Porsche became significantly less efficient. So why you might be wondering why I'm dancing around all these costs so much, because I think it tells us a lot about the bigger picture situation Porsche is in, because ultimately we look at these numbers to figure out, okay, what could be the path forward for Porsche. And given the increasing complexification of vehicles, more complicated powertrains, hybrid powertrains, fully electric powertrains, but then also the increasing number of advanced computers in cars, and computers that enable self-driving features, or at least let's call it semi-self-driving features. There's a lot of expense incoming for Porsche, or is already hitting Porsche. So for that reason, given this backdrop, I deem it very unlikely that Porsche can substantially reduce its R&D spend. They appear to have already cut back materially on admin, on selling expenses. So this would tell me that this elevated cost level is likely here to stay, except Porsche can somehow manage to sell more higher ASP vehicles. So if you want to sort of simplify the overall investment problem in Porsche, I think where time spent will be most useful is looking at Cayenne and 911 sales developments. And then of course making sure that other vehicles not falling off a cliff. So this is what I will be doing. I will be following quite closely Cayenne developments and 911 developments. But before I let you go, let's have a quick look at operating margin. Operating margin, because of the very low operating profit, of course, also super low at 2.6% in the second quarter. Porsche used to be quite strong in that metric. And then when we compare Porsche globally versus other automakers, we can also see that at 2.6%, they are basically in the bottom half and are surrounded by automakers that are also not doing all that well. Now, overall, one has to say that the auto industry profitability is very low right now because there's simply too much competition right now. The winner from all of that is the consumer, who can buy products at a pretty good price at the moment. And then lastly, we look at net income attributable to shareholders, and that metric dropped to just $221 million in the second quarter. That's down 83% year over year, and the first half of 2025 is down 66% year over year to just $772 million. And if we want to work out what this means for valuation, if we just look at a LTM, so last 12 months implied PE ratio, the number is 17.2 times. So how is this calculated? Quite simple. You take the market cap in euro, which is 37.3 billion at the moment, and you divide it by the last 12 months earnings, so you add up the last 4 quarters, but you have to take the euro number to avoid FX effects, and the resulting multiple is 17.2 times. Given Porsche is shrinking, here you have revenue first 6 months down 7%, 2024 down 1.1%. Keep in mind, it's not inflation adjusted, so the shrinkage was even more than this 1.1% in real terms. There's significantly negative earnings growth. Earnings down last year 30%, this year, as I said, 66% year to date. This multiple is potentially rather rich. Also, I'd like to point out that another company that has been in decline but for a lot longer, General Motors, trades at a little over, around less than half of what Porsche trades at. So some might be thinking, oh, comparison with General Motors is crazy. But if you really dive into the details, it might not be as crazy as it sounds at first glance. General Motors, if we exclude the JVs in China, which don't produce meaningful profit anymore, General Motors is effectively a North America concentrated company, has hardly any business outside of North America, at least not a business that generates any material profit. And then when we look at where the profit is coming from, it's coming from a very small group of vehicles, and to a large degree from a certain customer group, that is government contracts, that General Motors sells at margins comparable to Porsche. So even though, of course, General Motors is not a premium vehicle seller at the level of Porsche, on an economic level, the two are quite comparable. The big difference, of course, is the size. So basically, I'm not suggesting Porsche will trade anywhere near GM's multiple. Even for GM, it took a very long time for the multiple to erode to around 8 times. But to me, at least, it's unclear at the moment whether Porsche can ever come back to the levels it was just a few years ago, or whether it is facing a decade of decline. So Porsche will be releasing what they call pre-close call Q3 on October 10th. So that's just a little over 2 weeks away at this point. I will be covering the data that is shared on that day in detail. So if you don't want to miss it, consider following me. Thank you very much for listening. See you next one. Bye.